What's going on, YouTube? Welcome back to the Informed Trader. My name is Chris. Every day on this channel, we look at the stock market, analyze different ticker symbols, and show you my trading strategies. That way you can be more informed on your trades and make wise investments. I'm not a financial advisor, and this is not financial advice. If you are new to the channel, I'd really appreciate if you could like and subscribe. We've been growing really well for the last month and a half, and I'm thankful for each and every one of you that have become part of the community. So if you could like and subscribe, like I said, I'd really appreciate it. Now, in today's video, I'm going to be talking about how you can make an extra $300-$500 a month starting off, or even more depending on how much money you have available. Now, you can use this money to reinvest back into stocks, which is what I tend to do on my Robinhood account here, or you can pull it out, pay some bills off, pay some debt off. But the options here to make money are super valuable, okay? There's not a lot of places in this world where you can just make this kind of money, especially instantly, okay? We're going to be talking about selling cash-covered puts and covered call options, okay? Now, going into this video, I'm assuming that you have bought options before, and you understand the basic concept of buying a call option or buying a put option. Buying a call option, you're betting on the price to go up. You're dealing with a contract which is equals to 100 shares, or you're purchasing a put option, betting the stock to go down. Now, generally, when retail investors deal with puts and calls, they're not really worried about purchasing the 100 shares. They're trying to trade the premium of the contract, hoping that the value of the contract goes up and they can sell the contract to someone else who has to exercise it or let it expire worthless. Okay, so that's with this understanding that you have a grasp on basic options trading. Okay, so now you're going to be writing these options, okay, not just purchasing, but you're going to be the seller of these options, okay? And in order to be a seller of these options, you have to have the capital to purchase 100 stocks should the contract expire in the money, okay? Because at that point, it'll be exercised, forcing you to purchase 100 shares at whatever the strike price you sold the option at. And what I like to do in my Robinhood account here, as you can see, I have $7,000 invested as cash, but my buying power is around $6,500, as you can see. And this is my Palantir account, basically, for Robinhood. 300 shares on here, 20 shares of ARK Innovative ETF, and that's what this is comprised of. Now, if we were to look at my buying power here, you'll notice that it is not cash that I have sitting in the brokerage. This is just margin available. And I currently have $2,000 I've used in margin to purchase some of the Palantir dip when I didn't have cash on hand, and I will be paying that back down. And one way I will use to pay back down my debts is selling cash-covered put options, okay? Now, you may not like to touch margin. That's okay. I don't mind using it, especially as collateral, as you're going to see here. Now, to sell a put option, especially in Robinhood, is super simplified. Number one, you need to find a stock that you don't mind owning, okay? You need to plan on the chance that the price of the stock will land in the money and you will have to purchase 100 shares, okay? If you purchase 100 shares through a put option, then you would go and sell a covered call on those 100 shares. And if that lands in the money, then they buy the shares from you, and you can rinse and repeat the whole process, okay? Meanwhile, collecting a premium every time, between $100, $200, $300, depending on how far out your contract goes. So, for example, let's go over here to MVIS, Microvision, okay? Now, Microvision doesn't have weekly options, at least not on Robinhood. They have monthly options, okay? So if we were to look at their options here, we could go to April 16th, which would be about, 3 weeks from now. Okay, so that's a little long for me to want to sell an option on, but I generally like to stick around 2 weeks, but 3 weeks isn't bad, okay? So current price is sitting at $17.25 before market opens and things like that. If we were to have sold this option on Friday, this is what all these put options are worth. This is what someone would be paying you for this option. So let's say I believe Microvision isn't going to go down. It's only going to go up, especially within 3 weeks. I at least don't think it's going to be under $17 by April 16th. But if it does happen to go under $17, I'd be willing to purchase it at that, for example. So I would click on this put here, and you'll notice that it says you're going to sell this put. Make sure it's on sell, not buy. And I'm going to sell one contract. Minimum credit down here at the bottom is $335. That means When I sell this put, someone will purchase it, and $335 will be immediately credited to my account. It's $335. That's a paycheck if you're minimum wage, a weekly paycheck. All right. Now notice if I were to push review, it says update to $3.30, so we'll update it. Now notice my collateral here. Microvision price would be $17.25 now. I'm selling a $17 put. Multiply that by 100, and that is $1,700. That is what it will cost me to purchase 100 shares should April 16th come around the corner and Microvision is at 17 or under. Okay. Now, obviously there's risk involved because if Microvision is at $10 and I'm buying the share for 17, that's terrible. But, you got to be willing to purchase a stock and hold for a while at whatever price you're selling it at. Now, if Microvision's at $20 when April 16th comes around, the collateral will be put back as available buying power. The option will expire worthless, and I just made $330 for nothing. See, that's the way it works. And generally what I'll do with the $330 is put it right into something that's going to appreciate in value, like buy more stock. Or in this case, if I were to make this $330, it's going to pay down the margin I'm using out of that $2,000 that I bought some more Palantir and ARK ETF funds with on the dip. So that would be what you're selling a put for, okay? And then you would go in, if you have to purchase the 100 shares, then you go in and sell a covered call, which is essentially the same thing. So I would just go over here and click call, and let's say I ended up purchasing it for $17. Maybe I'd go and sell an $18 call, okay? Notice I have one contract for 100, and I'd be making another $325 here. It's going to update it to 30. Now, it says I don't have enough shares. You have to have the 100 shares. That's why it's called covered calls. But essentially, it'd be the same concept. If I have 100 shares and April 16th comes around, and let's say the price of Microvision's at $18.50, that would mean that the option is expiring in the money, and someone would have to buy the shares from me, 100 shares. So I make $325, plus I get all my money back, and then I can go and sell another put if I want. Now, if the option expires worthless and I'm still stuck with 100 shares, I'll just turn around and sell another one. I'll sell another contract for another $300. I'm making money on the premium every time, and I'm trying to make sure I own stocks that I actually don't mind holding on to for however long until a call expires in the money. You see what I'm saying? And what I like about doing this with margin is that I'm not tying up my actual cash for months on end, okay? One reason I like to use Robinhood is because of their instant deposit, right? So that what that allows me to do is keep money in my bank. I keep money in my bank until I want to purchase something or I see a great deal, and then I just instant buy and deposit money. I don't have to have the cash just sitting on the brokerage, just sitting at the brokerage doing nothing. And what that allows me to do is make sure when I sell a cash covered put, I don't have to have cash sitting in there. It automatically pulls it from my margin as collateral, not from cash, because I want to spend my cash on stocks or have it in my bank, okay? So that's one huge benefit of being able to use margin. Now, one thing to keep in mind about margin when you're dealing with options, if you were to scroll down here, for example, notice that the volatility is extremely high, and here's their maintenance requirement and initial requirement, 68%. So my buying power for Microvision with margin is actually less than my total ability. Like I had $6,000 something there, but I can only spend $4,800 to actually buy the stock, and then $1,000 less to purchase options. Okay, because that's due to the risk factor and the volatility of the stock, of course. Now, if we were to go into another stock, let's say CCIV, okay, which I just sold a put for $90, it expired in 2 weeks, and it expired worthless, so I made $90, and I didn't have to buy the stock. But anyway, if we were to look down here, my buying power for CCIV is $1,000 higher, okay? And then that would mean that my buying power for the options is still $3,200, okay? So just remember that you don't have your full buying power ability when it comes to purchasing options in the margin. But if you're using cash, then nothing to worry about, right? Now, what some people will do is extreme on betting the price will go up. So you can actually sell contracts that are in the money, right? At a strike price that's in the money, because I could technically sell a 30, as far as it'll go up, I could sell a $45 put expiring April 1st for $1,800. See up at the top here. That's how much would get accredited to my account, almost $2,000. But if I have to purchase the stock for $45, I'm missing it. I'd lose more than what the credit's worth. But if somehow CCIV was to explode and go above $45, as an extreme example, and I was betting on the price to go above it, I could make that premium without worrying about purchasing the stock, right? But generally, I go very close to in the money, but I generally try to stick to around out of the money. And, if I were to sell this putt here, it'd be $221 accredited to my account, and that would tie up that for 100 shares. And one thing to do as well when you're looking at trying to get the most out of the premium is don't try to buy options on a stock that is having a green day, okay? Because if it's having a green day, it means it's going up, and the putts are decreasing in value. You'll get the most money for your trade. So I just wanted to give you a basic concept of selling cash covered puts. So if you do this a 2-week out trade and do that twice a month, and you're looking at $200 to $300, you can make an extra $600, right? That would give you enough money to fund a Roth IRA every year without having to invest anything. Okay, and obviously I have $7,000 in here, and you should be investing long term. If you're in Robinhood or you're in another margin account, you have the capability of using that margin for your benefit. Just tie it up as collateral so you don't have to have cash just sitting there for months on end when good opportunities come. Use the margin for collateral. This is what I do, and this has worked for me, and it allows me to purchase more, right? So I use $2,000 margin to purchase more Palantir and ARK, and selling these cash covered puts will allow me to pay back the $2,000 without ever having to take my paycheck from my regular job and fund it back. You know what I'm saying? So technically you could sell cash covered puts a couple times a month and completely be able to fund your retirement over the years with just the premiums. And if you have to purchase the stock on that margin, the 100 shares, you turn around and sell a covered call on it, and do that until you get rid of the shares while collecting a premium every time. So guys, this is a very good strategy. A lot of wise investors do this, and it's something I'm adding, because I used to just buy options, right? Just, trying to YOLO my money into out of the money options, especially on stuff like GameStop or AMC when it's pumping. You can make a quick $1,000, $2,000, but if you want something that's more secure and something that'll be consistent, and you can turn around and invest the profits into your long-term holds, selling cash-covered puts and cash-covered calls is great. You can do it from your phone. It doesn't require a whole lot of effort, especially when you're using margin. Where else are you going to turn around and sell something in 30 seconds and make $300, right? Just like that. Hopefully this was helpful for you guys. I tried to do my best to go in depth on using margin and selling cash-covered calls and cash-covered puts and things like that. So if you could drop me a like and subscribe, I'd really appreciate it. Let me know if you use this strategy already or you're going to start down in the comments. You're on the Informed Trader, and I'll catch you in the next one, guys.